I expect gold to go to 8,000. That's just matching the old highs, though. That's not even abnormal. That's like saying, oh, I did it again. How about we go a lot further than that? Don't be surprised. Like 20,000, whatever. I expect silver maybe be $200. That fast. And people are looking for normality. Like, we go up 4 steps and pull back 2. All that nonsense. The norms will be shattered, just as the U.S. government and their central bank, just like the EU and Japan, don't control reality. So even if they set a price, I don't care. It doesn't mean it's going to stop there. I think silver is about to leave and overrun that attempt to control the price of silver. And we know some of the big banks have been manipulating silver. In fact, there's been a couple actual criminal convictions. And you've got the spread chart of silver versus gold. Ceiling, ceiling, ceiling. So if you have the combination of that first chart, gold breaking out versus the S&P, you want to be in monetary metals, not the stock market bubble. This chart says you not only want to be in monetary metals, you want to be in silver as opposed to gold, because it's going to beat gold. Hey, this central bank thing, this hasn't really been working like we thought it would. Instead, it creates boom busts. So you could end up with a situation this time around where gold goes up and becomes monetized, silver with it, where suddenly you go to a new price level, not just because of industrial demand for silver or anything like that, or repricing it out of an old reality into a new reality. We can get onto that in a minute. Where bigger decisions are made such that when gold goes up next time, all of a sudden this country, that country, that country, that country. No more fiat currencies backed by real stuff. And that could be the outcome of this move. So this stock market move, this gold move, commodity move, all the things we can talk about here shortly, could be different this time. They're likely to be in terms of significance.
Yeah. So the gold to S&P ratio was a lot higher and coming out of 2013, and you have that chart that goes back to that time period. Where could gold be headed from here? I mean, obviously it's moved significantly since the beginning of the year and last year as well. And so just curious on your thoughts of where gold could be headed.
Here's the quiet crisis buried inside this. When central banks lose control, markets stop behaving like markets and start behaving like warning signals. Gold spiking toward $8,000 or even $20,000 isn't about demand. It's about the system breaking its own rules. And when Michael Oliver points out multiple countries abandoning fiat backing, that's essentially a vote of no confidence in the monetary plumbing itself. The gold to S&P ratio, already rising since 2013, supports that shift. If liquidity thins or policy missteps continue, this different this time narrative could accelerate much faster than Wall Street models assume. Next, the conversation moves into historical patterns that make today's setup even harder to dismiss.
I'll give you 2 examples. You only have 50-year history. The U.S. government legalized it, in January 75, Over that time, there have been 2 major bull markets. And if you measure from the bear low that preceded the bull market to the bull market peak, bear low to bull peak, both moves, one peaked in 1980, one peaked in 2011, were 8-fold moves. Not the same dollar amount, but the ratio move. The same dimensionality of price gain, 8-fold, bear low to bull high. We're only 4-fold. We started from a bear low at 1,050. Multiply times 4, You're a little bit better than half the dimension of those 2 prior bull markets, which were of different duration, by the way. One was about 3.5 years, one was about a decade, So I'm not counting the years, I'm just saying how much did it move? And it moved under circumstances then that are by no means as dynamic pending as the ones we're sitting on right now. So I expect gold to go to 8,000. That's just matching the old highs, though. That's not even abnormal. That's like saying, I did it again. How about we go a lot further than that? Don't be surprised. Like 20,000, whatever. Again, it's going to depend not on so much the technical dynamics of gold when you do swing measurements or anything like that. It's going to be on these other factors that suddenly cascade into play.
This quietly exposes a massive historical gap. Gold's past 2 major bull markets both produced 8-fold gains, and today we're only halfway to that benchmark. Momentum this week compared to 1980 and 2011, despite far more unstable macro conditions, is the real tell. As analyst Michael Oliver notes, the prior bull markets happened under far milder monetary stress, and today's catalysts are far more explosive. If fundamentals and liquidity stack the same way, $8,000 isn't a moonshot. It's simply matching history. Next, he pivots to the emotional trigger that could unleash those cascading forces.
They're not evident right now to most people. All they're focused on is AI, But if all of a sudden other factors come into play, especially negative ones, hands go in the air, emotions occur, politics becomes dissembled, which it's already become. I mean, the two parties are fragmented internally, getting worse even on the GOP side's fragmenting. Suddenly, people don't have a sense of, it's 52 card pickup. And there's one thing they can rely on, like their granddad told them. Keep those gold coins, those silver coins. Okay?
Yeah.
And all of a sudden, those monetary metals are again monetary metals.
Yeah, there's been a lot of talk about gold revaluation by the United States government. And some folks are saying like, hey, I don't want to wake up one day and gold be revalued at, right now it's valued at $42 on the books. And I'm kind of wondering like, how would that interact with the momentum here?
All kinds of factors like that. But as far as I'm concerned, just as the U.S. government and their central bank, just like the EU and Japan, don't control reality. So even if they set a price, I don't care. It doesn't mean it's going to stop there.
Here's the uncomfortable truth this part hints at. Political fragmentation is becoming a financial risk, not just a social one. When markets fixate on AI while ignoring rising instability, they repeat the same blindness seen before every major downturn. The speaker highlights the government's absurd 1930s era $42 gold valuation, a reminder that official prices often trail reality by decades. As former Fed officials admit, confidence is the real currency, and that's exactly what's thinning. If emotions break before policy does, gold revaluation won't be controlled. It will be reactive. And next comes the metal that governments have tried and failed to suppress.
Okay, they don't fix price. They may try to. I mean, there's some solid arguments that they've been manipulating silver. We need to get onto that too. And capped it off for the last 50 years. Well, copper and lead have quadrupled. I'll get into that in a second. And suddenly I think silver is about to leave and overrun that attempt to control the price of silver. And we know some of the big banks have been manipulating silver. In fact, there's been a couple actual criminal convictions in that regard. But if you want to, we can get on to that next subject. And you've got the spread chart of silver versus gold.
Silver versus gold.
Yeah. Okay. Now,
what's happening here?
This only goes back to 2020. Okay. So 5 years. We know in early 2020 and to late 2020 and early 21, silver exploded in price. And therefore, the spread chart showing an ounce of silver divided into an ounce of gold was under 1% then. It was under 0.9%. Divide an ounce of silver, an ounce of gold. It shot up to over 1.5%. That's a huge percent gain. It's like buying a stock at under $9 and it goes over 15. Did it in like 6 months. These are weekly readings here, by the way, week to week.
This quietly exposes the contradiction Wall Street hopes retail investors never notice. Copper and lead have quadrupled, yet silver, a monetary metal, has been frozen for decades. The mention of criminal convictions for big bank manipulation isn't theory. It's documented DOJ cases as recent as 2020. And that silver to gold spread exploding from under 0.9% to over 1.5% in months shows what happens when pressure escapes suppression. If the next breakout mirrors that velocity, controlling the narrative won't control the price. Next, the discussion shifts toward what that spread really signals for the cycle ahead.
But then, since 2021, when silver was over 1.5%, which is still dirt cheap historically, silver to gold, it eroded. Now, price of silver is going up since 2020. We know that. 2020 was 30. We're now, $52, 53. So it's gone up, but its performance versus gold has eroded, meaning it's not gone up as much as gold from that point to the current level. Now, you'll notice since about March of this year, that thing exploded back up again. So silver's been outperforming gold for the last half a dozen months or so, gaining. But there's a green line on that top chart, the spread chart. If you can clear that line, this spread breaks out, and that line goes back over 3 years. Ceiling, ceiling, ceiling. It's called what you call a base, okay? You break out over that, it's a fresh buy signal, meaning time to buy silver rather than gold. Doesn't mean gold's going down, just means silver's going to beat it. So if you have the combination of that first chart, gold breaking out versus the S&P, what it's telling you is you want to be in monetary metals, not the stock market bubble. This chart says you not only want to be in monetary metals, you want to be in silver as opposed to gold, because it's going to beat gold.
Silver's brief lag behind gold masks a more potent breakout that's quietly forming. Despite climbing from $30 in 2020 to $52, $53 today, silver's performance relative to gold eroded for 2 years, highlighting suppressed momentum in a historically undervalued metal. Since March, however, silver has surged, breaking a 3-year ceiling on the spread chart, signaling fresh buying opportunities. Michael Oliver points out that a breakout above this green line historically precedes outsized gains in silver versus gold, indicating that portfolios emphasizing monetary metals may see real upside while equities stagnate. Next, the focus turns to how historical ratios reinforce this silver opportunity.
I'm strongly of the view, assessment, that when that first chart breaks out, gold versus S&P, as I said, it's already broken out versus the broader stock market indices. Silver's going to break out versus gold. And already this spread chart doesn't show where it is right now. It's up. It's moving up toward that green line right now. This chart's a week or so old, and we know a lot has happened in the last week. So that's another spread I'd watch, because it's not only telling you monetary metals are a place to be, but now you really want to focus on silver. Now, where might it go? If you go back 50 years and measure the peak point of where silver was versus gold each of those years, what was the highest rate, percent level, ounce of silver? 20 of those 50 years, it was at 2%. And some of those years weren't even bull years. In fact, the bull years, 1980, 2010, 11, silver was up to 3.5% and more the price of gold. But just routinely, 2% is not uncommon, 20 out of 50 years. Well, heck, right now you're at 1.27% as we speak. If it went to 2%, just a norm, well, that's a huge move. That's almost a doubling of the price of silver in relation to gold.
Silver to gold ratio quietly reveals undervaluation ignored by mainstream coverage. Historically, silver routinely reaches 2% of gold's value in 40% of the last 50 years, with peaks up to 3.5% during major bull markets in 1980 and 2011. Today, at 1.27%, silver is far below historical norms, indicating potential for nearly a doubling if it returns to routine levels. Investors focused only on headline prices may miss this systemic opportunity, while monetary metals quietly outperform equity indices. Next, the analysis turns to how silver miners leverage this trend.
So anyway, this is an area where I'm mostly focused personally in my investments, and they're exposed at the end of each report. I disclaim what I own. All my emphasis is in silver, sometimes silver calls, silver miners.
Yeah, I want to look at the silver ETF versus GDX.
I got it. This sort of reflects what you saw on the silver gold chart. Back in 2020, you had this surge where the silver miners beat the gold miners. It's like buying a stock at about $96 and it goes to 135 in 6 months. The spread went from about 96% to about 135. Divide the price of SIL, the miners ETF, into the price of GDX, which, by the way, does hold some silver miners, but it's primarily gold miners. But since then, even though SIL and GDX are now above, have advanced, and they're above that 2020 price high, the spread is not, meaning the silver miners have sort of gone sideways on the spread chart back to 2022. I've got a little black line there on the top chart, horizontal line that shows that they've oscillated either side of sideways since 2022. So for 3 years, basically the silver miners haven't really underperformed, but they haven't outperformed. But there's a structure, that green line, that's been hit 4 times since 2022.
Silver miners' sideways movement masks a growing structural opportunity that few are tracking. Although CL and GDX have surpassed their 2020 highs, the spread has oscillated without a decisive breakout, indicating the market has been consolidating rather than trending. Historically, when the green line on this spread chart is approached or breached, it signals momentum shifts favoring silver miners over gold miners. For portfolio managers, this is critical. It identifies an inflection point where miners with silver exposure could outperform significantly in a market still dominated by equities. Next, Michael Oliver breaks down why this green line is key for timing allocations.
So it's a clear structure. You close a month out above that green line, and right now we're pushing to do it. The current levels reading of silver versus GDX. Then not only is silver breaking out versus gold, but the silver miners are saying, I'm breaking out versus the gold miners, which would echo what we're arguing is likely to be the case, silver versus gold. So my emphasis among the miners now is to buy silver miners as opposed to gold miners. I think they've got a lot more to go on the upside.
Silver miners are signaling a breakout that could flip traditional allocations without anyone noticing. The spread chart shows silver not only outperforming gold, but miners following suit versus GDX, confirming an early-stage trend few mainstream analysts acknowledge. Historically, a monthly close above this green line has preceded rapid gains, making it a critical metric for investors seeking exposure in monetary metals. For those still overweight in gold or equities, the evidence suggests shifting to silver miners could capture upside overlooked by institutional narratives. Next, the discussion moves into how this sets the stage for broader monetary metal rotations.
How come silver's still stuck, or has been stuck, for 50 years? Gold hasn't done that. Gold's continually made dramatically higher highs at each move, but silver's been capped. Well, one argument is, and it's got backing, is that banks, probably backed by the Fed or encouraged, have been trying to control silver price. Ultimately, that kind of manipulation doesn't work. Reality takes over. And sometimes when you compress something like that, all you've done is make it explode even more when it unleashes. So good luck, guys. I think we're on the cusp of that right now. And I think silver is about to do something. And we see it in the technicals. I see it in the spread relationship. That's why I'm watching gold S&P, moving into monetary metals. So this industrial aspect you mentioned, yes, it's a factor. But ultimately, there's bigger factors. And it's the movement in asset classes into monetary metals because of the perceived, and I think will show itself very soon, actual vulnerability of the stock market, especially the U.S. stock market.
Yeah. Okay. So some folks would, argue that, okay, we're going to get a sell off. People are going to need liquidity, and they have these price targets set at, 3,200 on gold, or they may get back into silver at, $34, $35, whatever the case may be. Right.
Silver's this decades-long suppression hides forces few investors openly acknowledge. For 50 years, while gold surged to new highs, silver remained capped, likely influenced by Fed-backed banking interventions. Yet, history shows such manipulation eventually fails. Technicals and spread relationships now indicate a tipping point, suggesting a major reallocation into monetary metals may be imminent, especially given U.S. stock market vulnerabilities. Analysts setting conservative silver targets around $34 to $35 may be missing an approaching paradigm shift. This isn't just industrial demand. It's systemic, signaling that traditional assumptions on silver pricing may no longer hold. Next, we examine why historical spreads hint at explosive upside for silver.
Yeah.
And I'm kind of wondering, if those price levels we've already surpassed them. Like, are we going back?
No.
Could we go back to those price levels or what?
We're on the cusp of a major reality, a new reality for silver. And I'm arguing it's highly likely to happen. First off, if that spread chart I showed of silver versus gold with that ceiling goes back over 3 years, boom, boom, boom. When you break out over that, same spread chart event occurred 5 months before it Silver reached 50 bucks in 1980. It moved from the 20s, no, from the 15 level, I think it was. It's like a quadrupling in price of silver in 5 months. And the only technical we can find that said it's about to begin was not the bull trend in silver. It had already been going on. It had been going up for years. Suddenly it went electric. That spread broke out. 2010 and 11, silver had already been going up since 2000, 2001. And in 2010, in September through April 2011, silver went up in that 7-month period, double and a half. Bam, the spread broke out first. That spread breaks out, we set the clock. And I'm arguing that probably in the next couple quarters, remember the copper move and the lead move. And there's plenty of other markets that have done that.
Breakouts in silver's spread chart foreshadow rapid price moves few market participants anticipate. In 1980, silver quadrupled from roughly $15 to $50 within 5 months after a spread breakout. And similarly, in 2010 to 2011, silver surged 2.5x in 7 months following the same technical trigger. Current charts suggest a comparable breakout may be imminent, especially as monetary metals outperform traditional equities, echoing patterns seen in copper and lead markets. Investors relying on linear expectations risk missing the velocity and magnitude of silver's next move. Next, we assess how these dynamics could push silver toward $200 in the near term.
I expect silver maybe be 200 bucks. That fast. And people are looking for normality. Like, we go up 4 steps and pull back 2. Go up 3, pull back 1. All that nonsense. The norms will be shattered. And you'll go into a new reality. And yeah, you'll get a sell-off at some point, but it's likely to be in a reality that possibly even overshoots what a real price conversion of silver would be, factoring in the decay in the value of the money unit, the dollar. Not versus other currencies, but its real value, the quantity of dollars, the M2 chart, which is, goes up about 90% in supply every decade. Okay. And so being 200 bucks might just remotely match the 1980 high. So, and I expect it to happen very quickly. And frankly, if you're not there, you're going to miss it. But don't use the normal tools. They won't work.
Expecting silver to $200 isn't hyperbole. It's a recalibration against real dollar value, not headline prices. Traditional trading norms, stepwise gains with minor pullbacks, may fail, as monetary expansion, illustrated by M2 increasing roughly 90% per decade, amplifies silver's upside. Historical analogs, like the 1980 peak, suggest potential overshoots beyond nominal fair value. Investors unprepared for nonlinear moves risk missing substantial gains, emphasizing that conventional tools and expectations won't capture this market's speed.
And here's where the U.S. context really matters, because none of this is happening in a vacuum. You've got a political system that's basically in permanent campaign mode, a fiscal position that would have looked insane even by 1970s standards, and a central bank that's trapped between inflation and insolvency math. Whether it's a Trump administration, a Biden administration, or some future coalition that hasn't even been named yet, the math on the screen doesn't care who's sitting in the Oval Office. We're running multi-trillion-dollar deficits in what's still called peacetime, rolling over mountains of short-term debt at higher interest rates and pretending that a few basis point moves from the Fed can finesse this into a soft landing. That's not policy. That's hope with a press conference. Think about what both major parties have converged on over the last decade. For all the drama, tweets, and hearings, there's one unspoken bipartisan agreement. Deficits don't matter until they do. Under Trump, you had tax cuts layered on top of elevated spending. Under Biden, you've had large spending programs layered on top of already embedded commitments. Different branding, same result. The debt stock climbs, the interest bill grows as a share of the budget, and the only politically acceptable response is more intervention when markets wobble. That's why this conversation about gold and silver isn't some fringe bug rant anymore. It's a quiet recognition that the currency itself has become the primary variable, not the neutral measuring stick. Now imagine what that looks like when the next real crisis hits. It doesn't have to be a 2008 replay. It could be a credit event in the Treasury market, a geopolitical shock, a cyber incident, or even just a loss of faith in the Fed's ability to keep inflation expectations anchored. Whoever is president at that moment, whether it's Trump coming back with a mandate to smash the old order or another administration promising stability, will have the same short list of tools: emergency liquidity, direct fiscal transfers, and some version of yield curve management to keep long rates from blowing up the debt. All three of those tools weaken the currency. That's how you wake up one morning, and gold isn't just a line on a Bloomberg screen. It's a referendum on the whole policy regime. You can already see the early signs in how other countries are behaving. Central banks outside the U.S., from emerging markets to traditional U.S. allies, have been quietly accumulating gold, not because they suddenly became nostalgic for a 19th century standard, but because they see the trend: weaponization of the dollar system, sanctions as a routine tool, and a growing risk that being too dependent on one currency is a strategic vulnerability. When Russia's reserves were frozen, when talk about BRICS currency alternatives appears at every summit, that isn't about tomorrow morning's FX rate, it's about long-term optionality. And in that environment, you don't need an official gold standard announcement for gold to be de facto remonetized. Markets will do it for you by pushing the price to a level that reflects its role as the asset you can't print. Silver rides right alongside that process, but with its own torque. Unlike gold, which is almost purely monetary and psychological, silver straddles two worlds. It's a monetary metal and an industrial metal. The U.S. push toward electrification, solar build-out, and high-tech manufacturing is structurally bullish for silver demand, even before you overlay the monetary stress. You've got federal incentives for EVs, subsidies for solar, and reshoring efforts that all quietly lean on metals that can't be conjured up with a keystroke. So when the monetary narrative collides with that industrial backdrop, you're not just repricing silver for fear, you're repricing it for the fact that the 1970s playbook didn't assume gigawatts of photovoltaics being rolled out every year. And this is where the $200 number for silver stops sounding like fantasy and starts looking like a late mark to reality. If the dollar has been silently debased for decades, if M2 has roughly doubled every 10 years, then simply matching the old highs in real terms demands numbers that feel obscene to people still thinking in 1990s price structures. In nominal terms, $50 silver was a shock in 1980. Adjust it for the cumulative growth in money supply, the compounding of deficits, and the global habit of solving every downturn with cheaper money, and suddenly 200 looks less like a spike and more like a catch-up move. Add in a period of emotional panic, policy confusion in Washington, contested elections, government shutdown theatrics, maybe a flare-up over debt ceilings, and markets don't move in smooth stair-steps. They jump. Donald Trump is actually a useful symbol here, not because of what you think about him politically, but because of what his rise represented. A huge chunk of the U.S. electorate giving a no-confidence vote to the established order. That same impulse is now bleeding into financial behavior. Distrust in the media becomes distrust in official inflation numbers. Distrust in the intelligence community quickly morphs into distrust in official narratives about markets being stable and under control. So, whether it's a Trump rally promising to drain the swamp, or a progressive campaign promising to tax the rich and cancel debt, both are telling you the same thing. The center is fraying. When the center frays in politics, the center frays in money. People reach for things they can hold, not platforms they can download. Overlay that with the emerging conversation around central bank digital currencies, CBDCs. The idea being floated in policy circles is that a digital dollar could give the Fed and Treasury more precise control. Programmable money, direct transfers, real-time tax collection, even expiration dates on certain categories of spending. From a technocrat's standpoint, this is elegant. From a citizen's standpoint, it's a massive jump in control. If you can imagine a future where your access to savings is partly digital and partly subject to policy rules, You can also imagine why some people will want an asset that sits entirely outside that system. Gold and silver coins in a safe or allocated metal in a vault with clear title suddenly aren't old-fashioned. They're just offline. And the stock market backdrop makes this even more asymmetric. A huge portion of current U.S. equity valuations rests on a handful of mega-cap tech names, many of them riding the AI narrative. That doesn't mean they're bad companies. It means they've become the default parking lot for excess liquidity. When everyone crowds into the same theater and someone yells, "Fire," in the form of inflation reaccelerating, a bond market tantrum, or a geopolitical shock that breaks supply chains again, those multiples can compress brutally. At the same time, monetary metals, especially silver, are coming off relatively depressed levels versus financial assets. You don't need the S&P to go to zero for gold/S&P or silver/S&P ratios to explode. You just need a rotation, a repricing of what's considered safe. Look back at prior U.S. cycles and you'll notice something subtle. Big political inflection points often arrive near big monetary ones. The end of Bretton Woods in 1971, the inflationary mess that helped usher in Reagan, the dot-com bust that framed the early Bush years, the 2008 crisis that set the stage for populism across the spectrum. Now we're seeing a similar layering. Record debt, polarized elections, loud debates over the Fed's role, and an undercurrent of "the system is rigged" that exists on both left and right. In that environment, an $8,000 or even $20,000 gold price and triple-digit silver aren't really price forecasts. They're signals that the monetary system itself is being repriced by the crowd. Of course, none of this means you wake up tomorrow and the chart is a straight ascent. There will be volatility, shakeouts, and scary corrections. In a major equity sell-off, you can absolutely get a moment where everything is dumped for liquidity, metals included. That's how 2008 looked in the early stages. But what matters is what recovers first and stronger. In 2009 to 2011, it was gold and silver that outran the recovery in many other assets, reflecting the lingering distrust in paper promises. The argument here is that the next cycle could be a heightened version of that. Shorter delays, faster moves, bigger percentage swings, especially in silver once that spread against gold actually clears and holds above the long-term ceiling. From a U.S. household perspective, the dilemma is simple but uncomfortable. For decades, the responsible thing was to put your savings into dollars, treasuries, or broad index funds and trust that the system would muddle through. Now, with inflation episodes fresh in memory, with social unrest periodically flaring, with every election framed as existential, that simple plan doesn't feel as safe. That's why you're seeing more mainstream discussion on financial TV, in congressional hearings, in campaign talking points about debt sustainability, entitlement reform, and even the possibility of some kind of de facto revaluation. They won't call it default, they'll call it financial repression, inflation management, temporary measures. But for savers, the net effect is the same. Your units buy less. So when I talk about gold matching prior eightfold bull moves, or silver overshooting to $200, I'm not waving a speculative flag. I'm describing what happens when a country tries to run 21st century politics on a 20th century monetary template while the rest of the world quietly diversifies away from its currency. The U.S. will still be powerful. The dollar will still be widely used. But the premium, the unquestioned automatic trust, may not survive the next round of crises. And markets, not speeches, will decide the new terms. In that scenario, monetary metals are less an investment theme and more a seat on the lifeboat. The exact price targets, 8,000 gold, 20,000 gold, 200 silver, are just rough coordinates. The deeper point is that the journey from here to there could be compressed into a far shorter, far more violent time window than most risk models allow for, especially if those political and monetary shocks arrive close together. That's why the spread charts, the historical ratios, the DOJ cases against spoofing, the central bank buying, The fiscal blowouts in Washington and the fraying party structures all belong in the same conversation. They're not random headlines. They're facets of the same trend. Confidence leaking out of the system and looking for a new home. And when that leak turns into a rush, you want to at least understand why the metals moved, even if you decide after weighing the risks and your own situation how much exposure, if any, makes sense for you.